Right. So de-risk your retirement, the three keys to help ensure that you have enough. Now, I'm going to start my presentation with telling you all a simple story that you might probably connect with. Story is going to be about some clients that are near and dear to my heart, but we're going to use fictional names for it. So Paul and Renee are 65 and 67 respectively, and they became clients about 3 years ago. Came into my office needing help with retirement income, not sure if they have enough. Both of them had mothers that were ailing with dementia that they were taking care of. They worked for the state, and one was an educator, had about $1 million in savings from 401ks and IRAs, and were truly worried about whether or not they had enough income to retire at their age. Now, the neat part was, like I said, they worked as educators and for the state, so they did have some pensions, but with their mother situation, having to take care of their parents' home, as well as taking care of the long-term care situation with both of their mothers and empty nesters, they just weren't sure if they'd be able to survive and keep up the same lifestyle. So I sat down with them, showed them an income plan, showed them a full retirement plan, and talked about long-term care scenarios for them since they were actively experiencing it. And they were able to go home and sleep at night after meeting with me because they found out that they were going to be okay. But I use them as an example. They are now some of my favorite clients who are probably some of our biggest ambassadors, but it was because what we're going to talk about today, we implemented planning for them that changed their life and their outlook. So some of you all might have similar concerns that they have. You know, am I going to run out of money? Or can we retire comfortably? Or, you know, will my family be okay if something were to happen to you? Regardless of your individual situation, I believe that everyone deserves a confident retirement, one in which you know your money will last as long as you do, and one in which you have the freedom to choose your life that you desire. So when people come into our office, they usually have the same questions that many of you today might likely have. Do we have enough money to put away? When can I retire? Can I stay retired? Is there a chance that I might outlive my money? Will my family be taken care of if something happens to me? For the past decade, we've been working with hundreds of families just like you to help them answer these questions and retire with confidence. So as we get started this morning, it is important that you understand that today is simply part one of a two-part process to help you pursue the confidence and reassurance that you're after. So today we'll cover more generalized information that should be relevant to everyone here. And then as we conclude, you'll each have the opportunity to take part in part two of this process, which allows you to come in and visit with our team one-on-one, get your specific questions answered, and allow us to address your individualized situation and circumstances. So if that sounds good for everyone, we'll go ahead and move on. So great. So we do have our disclosure statements, just something you to quickly read through, just making sure that you understand that we cannot make any promises or guarantee that you will accomplish any goals. All investments are subject to risk, including the potential loss of principal. No investment strategy can guarantee your profit or protect against loss in periods of declining values. All these references are just our disclosure, letting you know that just because these situations work immediately for one person does not mean they work for you. However, we will make sure that we sit down and make custom tailored planning for you. So this morning, we want to talk about three key areas of risk. First, we'll talk about the danger of not having enough income to last throughout the rest of your life and how we can help address that risk with a guaranteed retirement income plan so that you'll never outlive your money. Second, we'll discuss how to make sure that money that you have saved and the lifestyle you expected in retirement is protected, even if the stock market drops dramatically. And then third, we're going to make sure that you're not paying too much in taxes, both now and when you retire. That sounds fair. Then let's get started. We're going to look at risk number one, not having enough income. The first thing I want to talk to you all about this morning is income, because without question, the most common worry that we hear from those coming into our office is, will our money run out? Will we really have the income to last the rest of our lives? What those folks are really asking us is, are we going to be okay? You see, we spend a large part of our life working with a paycheck coming in every 2 weeks or every month. And it's a good thing because we all have expenses, our house, our car, our food, our fun. They all cost money. And when we retire, those paychecks stop, but those expenses do not go away. Now, many people out there will tell you that they need less income when they retire, but I am telling you that that may not necessarily be true. Sure, some expenses like clothes for work might go down, or maybe you could consolidate down to one car if you needed to, but those expenses are usually replaced by others. At least many people hope they are, right? Because when you retire, you often have more time to travel, more time to go out to eat, and hopefully more time to have fun and enjoy it. So if we could take a quick poll here, I doubt we even need to, but if we did, I don't know anyone who has lived 60 or 65 years just so they could have a lower standard of living when they retire, right? Well, here's the good news though. You don't have to. At Capital City Financial Partners, we spend a great deal of time and effort helping our clients create strategies designed to help protect those income sources so that they can feel more confident in the income that they'll be generating in the days ahead. So let's take a quick look at what I call the three-legged stool of retirement income planning, or perhaps more appropriately put, the three-legged stool that was. So let's look at the first leg of the stool, right? Pensions. Now, this is how many of our parents retired. When they retired, maybe from a company that they worked for at maybe 30 or 40 years, many of them had a pension. Pensions were really nothing more than a monthly paycheck they received from their former employer for the rest of their lives. Next, your parents had Social Security. Now, how long were those pensions designed to last, right? For life. And how long was Social Security intended to make payments to them, also for the rest of their lives? And then they had any personal savings they accrued as the third leg of their retirement income stool. This could literally be money they had in savings or various investments they made up over the years of this leg. Could be made up of a number of different things, right? Now, the idea was that they'd have those two legs of this stool that would be considered 100% predictable and reliable sources of income, the pension leg and the Social Security leg. Just one of, and there's just one of those legs that was responsibility of the individual, that was the personal savings part. But how has that changed over time, and especially in what we're facing right now? Today, very few companies offer pensions, and even those that do have often lowered their value. So for the vast majority of retirees, including most of us here this morning, the leg of that stool is gone. Then Social Security would be next, right? So the question is, would most of you here this morning say you feel that Social Security is stronger or weaker than it used to be? I'm pretty sure you're all saying weaker. And now, while none of us know exactly what the future might hold for Social Security, many would contend that before the program would ever go belly up, it would simply reduce the amount paid out to retirees each month. But the bottom line is, many wouldn't consider this leg as certain as it used to be. That's why you can notice the cracks that we have in our stool, which now leaves a lot more of the weight being balanced on the third leg of your retirement income stool, your personal savings and investments. So, we had a couple, let's just call them Roger and Debbie, right? And they came to one of our seminars, very similar to this. And at the end of the meeting, they said they wanted to meet with me. And 2 days later, they came into my office. We sat down in the conference room. And after we've gotten a chance to know each other over a cup of coffee, Roger told me that his biggest concern was that he was worried that they were behind. They didn't get the best jump on things, and he was worried that they'd run out of money when they retire. So then I asked him to elaborate a little bit more and give me more details about their situation. So over the course of about 30 years, Roger has had 3 different jobs. He worked for the printing industry, he owned a small business for a little while, and for the last 19 years, he was working with the marketing company. 3 jobs, 3 separate retirement accounts. Together, he and Debbie had some savings and some stocks and a few bonds. The more we got to talking, the more it sounded like they kind of had a junk drawer. Now, surely, I'm not the only person here this morning that has one of these in their house. We actually have a few of them in our house, but the one I'm thinking of is in the kitchen over just to the left of the coffee pot. The thing is absolutely incredible. It has the most amazing stuff in it. That rare size extra battery for the garage door remote, a set of tiny eyeglass screwdrivers, a bottle of super glue, the spare key to your daughter's house or your sister's house, a zip tie, cell phone charger, maybe even the VCR remote from the early 90s. I'm pretty sure you could survive on a deserted island with what's inside of our kitchen island junk drawer. It's got amazing things in it, and yet it's the single most infuriating experience to ever have to go into. So I know you all can relate to that. So the more that Roger and Debbie talk, the more this is what their situation sounded like to me. I remember Miss Debbie saying, Michael, we got a little bit of a lot. And every year we go in for this appointment where our advisor tells us how all that different stuff is doing. We look at a bunch of different graphs and things and we nod, but then we walk out together and just kind of shrug our shoulders because neither one of us has any idea of what any of it really means and how it's all going to work together. They just want to know, can they just make this simple? So folks, we see clients like Roger and Debbie all the time. People who at some point in their 40s or 50s knew that they needed to get started. So they grabbed the phone, set an appointment, and did just that. And I've got to tell you, I credit them for doing it. They got started. And someone helped them get those same investments going and put into some type of motion here or there. We see clients just like you all the time who have a portfolio. They just don't have a plan. Or if they do have a plan, it's way too complicated. And in retirement, complexity creates uncertainty. That truly concerns me, right? Folks, I've been doing this over 20 years. And in all that time, I've never understood how anyone could truly retire without being confident where their income in retirement was coming from. In retirement, income truly becomes your lifestyle. And in that sense, you could basically say income is that outcome. So I'll just ask you, how many of you here really do have a written retirement income plan in place at this point? And to be clear, I'm not talking about a collection of retirement income sources or things that you could tap into for money if you needed to. What I'm referring to is a detailed written retirement income plan that lays out exactly how those sources are going to be tapped, in exactly what order, and in what amounts over what periods of time to help you keep your retirement lifestyle from ever being disrupted. Now, folks, if you haven't ever had this kind of detailed written retirement income plan put in place, you're absolutely not alone. The reality is roughly 80 to 85% of those who come into our office after events, seminars, or meetings, they've never had this done for them. So if we don't do anything else after today, if we don't even end up working together, and the only thing we do for you is have you in and complete a written retirement income plan so that you walk out of our office with a greater confidence about your financial future, please don't leave here today without scheduling that review. Now, we understand that not all firms do this, but at Capital City Financial Partners, we feel strongly that retirement without the certainty of income really isn't retirement at all. We were going to send out some response packets to discuss the words written retirement income plan. Should be midway down in the packet. If you don't have a retirement income plan in place, again, please don't feel bad about it. Most people don't. And if that's something that you would like to address, simply check the address box written retirement income plan beside it, and at least we could explore that for you. All right. And they will be sent out to you after the webinar, okay? So let me ask you, when it comes to spending your money in retirement, is anyone here familiar with what the spending rate or percentage we call conventional wisdom would suggest you could safely spend each year without running out of money? I'm sure some of you have heard of the 4% retirement rule, right? Oh, hit the wrong thing, sorry. That's right. The conventional wisdom has been the 4% rule, right? So many financial advisors, and myself included, have contended that as long as you don't spend more than 4% of your retirement savings every year, you should be good to go and never risk outliving your money. And while many people out here are now starting to tell you that a safe withdrawal rate is actually closer to 3%. So let's make clear for everyone the math in this, right? So if you had even $1 million heading into retirement, and you are wanting to take what many consider a safe spending percentage each year, the average retiree would take 2% or 3%. That equates to $20,000 in annual income or $30,000 in annual income. For most of you here today, that doesn't exactly light your fire. And in 20 and 30 years from now, when inflation has continued to erode the buying power of said $20,000 or $30,000 per year, I'd venture to guess you'd be even less excited about it. But that's the bad news, right? The good news is that with retirement income planning, you're not necessarily limited to a 2% or a 3% spending rate. Can you get a higher cash flow and take less risk? Many times you can. It could be 4% or potentially even 5% or higher, depending on your unique circumstances. But that is why it is so critical that you sit down with someone who knows how to put together a true retirement income plan. So that's all we're really going to talk about regarding outliving your money. So that's our first topic of income. So we're going to transition over to our second of our three topics, which was risk, right? And the risk number 2 was keeping your assets protected, even if the market should drop. So if there is one word that I've heard most of 2022 and a lot in the last 2 weeks, would be the word volatile. We live in some pretty volatile times, whether we're talking about the global pandemic, whether we're talking about domestic politics, protests, unrest, war, right? People's reaction to social media posts. We are in the middle of some of the most turbulent times many of us can remember. So what does that really mean? Well, Financially, it simply means that with so many things happening so fast, the stock market can go up and down a lot, almost like a roller coaster. But what does that mean for you? Well, one question that many of our clients have is, will a drop in the market change our reality or our day-to-day existence in retirement? And that is a really good question. So let's just talk for a moment about two things: risk tolerance and what I like to call the danger zone, right? So let's use another story, right, for context. Another couple, we'll just call them Tom and Eileen. They sat at a seminar very similar to this. And at the end of the seminar, Eileen was nudging Tom about signing up. Truth be told, I'm not so sure he thought they needed to come in and see us. But please never underestimate the power of a persistent woman. So they signed up to come in and visit with us. And about 3 days later, they were in my office. They had about $700,000 saved for retirement in various accounts between their 401ks and a few IRAs that they had. And as we sat there sipping coffee and talking about their grandkids, some of the dreams of spending time with them and how they want to enjoy retirement, I asked them, so given the goals, how much of your money are you comfortable having at risk in the market? Now, folks, let me just give you some context. Tom's 64, Miss Eileen was 63. They're college sweethearts. They were really adorable to watch as we sat there because she would always let him answer first and then correct him. But Tom was hoping to punch out of here in the next year or so and retire from Dominion Energy. And he was the first to answer, how much risk? I'd say about 10%. And Miss Eileen literally was putting her hand over his mouth and started smiling. And like what he meant to say was $10. Now, people, that is what we call a conservative investor. So I laughed and I asked them, would they be comfortable with me running an analysis of their current portfolio? I wanted to see what their existing advisor had put together to just make sure that what they currently stood to lose matched what they thought their risk tolerance was. And, the reason why I really wanted to ask that question, because some of you here know this very well, but I'm going to say, do y'all know what happened on March 9th of 2020? Well, to answer it while you're thinking, it actually marked the end of a 10-year run in a bull market as the beginning of the stock market crash of 2020. Obviously, coronavirus rocked the world and days later was deemed a pandemic by the World Health Organization. But March 9th, 2020 marked the Dow Jones' largest point plunge in history up to that point. I said up to that point because the market then experienced two more record-setting point drops on March 12th and March 16th of 2020. Now, the good news was these historic drops were then followed by an amazing rebound in the market. After bottoming out on March 23rd, 2020, exactly 1 year later, the Dow Jones, the S&P 500, and the NASDAQ had soared between 76%, 76%, and 95% respectively, making the 12 months between March 2020 and March 2021 one of the best 365-day stretches since World War II. So let's look at a bit of history on the bull and bear markets. So let's take a look at the chart with me for a second. We all know that bull market is when the market is on the rise, and a bear market is when things are on the decline. So many of you know that a correction is a drop of 10% or more in the market following a previous upswing. Now, the question is, does everyone here understand that when looking at the long-term history of the market, rises, falls, and corrections are absolutely cyclical, meaning that they're not predictable down to the date on which they're going to occur, or when we'll have a once-in-a-lifetime occurrence like pandemics or war. Because if we could, we'd all be rich. But the cycle of them happening is predictable, right? In fact, if we go back almost 100 years to 1926 and look at what's happened in the market, you will see a significant rise is always followed by a correction and then a period of decline. For example, I'm sure many of us here remember the period between 1995 and 2001. You can see it here on our stock market chart right before 2000. That right there was called the dot-com years. The internet was exploding. All sorts of startup tech companies and software companies were erupting, and the market was on a tear. And then the predictable correction followed by 2.1 years of bear market activity. This cycle itself is 100% predictable. In fact, we even know that the average market run-up or bull market lasts about 4.5 years, and the average market decline or bear market lasts about 1.4 years or 1.25. So that's why I'm always interested so much in how much our clients have at risk inside of the market, because, I wanted to really see if Tom and Eileen would be comfortable having that amount of money at risk, because every bull market is virtually guaranteed to be followed by a correction. And when, not if, but when this happens, I never want any one of our clients sitting in retirement being overexposed to losses. So Tom and Eileen both agreed it would make sense for us to look at their exposure. So our team here ran the analysis for them absolutely free of charge. And when they came back in the next week, we sat down again over some coffee, and I shared with them really good news. Their portfolio over the past 10 years had performed well. So of course, candidly, in a decade where the S&P itself had an annualized return of 10.75%, hopefully everybody here's portfolio has performed pretty well. That said, I also had to share some other news with them. I had to let Tom and Eileen know that if the stock market dropped again, like it did in 2008, they would stand to lose nearly 40% of their retirement savings because of how their retirement assets were currently allocated and exposed to risk. So that means that instead of going from 700,000 down to 630, like Tom said he would be comfortable with in a 10% drop, they would have plummeted from 700,000 down to 420,000. That's a $280,000 drop, ladies and gentlemen. And in their case, that was more than twice what they were earning combined as a couple on an annual basis. And why? Because as conservative investors, their risk tolerance was not at all matched up with their actual portfolio. And can I be completely candid with you? We see this all the time. So like one of the services we offer every client who comes into our office for a visit is the same analysis of their current portfolio. I cannot tell you how many times clients have been blown away by how much more risk they were taking than they actually thought they were. This just shows the last 10-year bull run. So let me show you one other variable many people overlook when planning for retirement. So let's take a look at two fictitious brothers. Let's just call them Steve and Bill. Steve here on the left worked in the consulting business most of his life, and his brother Bill here on the right was a small business owner. Let's say that retirement, both of them had the exact same amount in the IRA they planned to tap into for income. They say had about 500,000. And they both plan to use $30,000 of their IRA each year for income to cover living expenses. The only difference between them was when they decided to retire. Steve decided to give up consulting in 1990, and Bill decided to step away from his business 10 years later in 2000. They had the exact same IRA balance and the exact same financial goals for their IRAs. But let's look at what happens in this example. If you look at the IRA account balances, you'll see that Steve has over 1.2 million in his IRA after 10 years of taking 30,000 in income, while his brother Bill has only 156,000 left. So you're like, well, how can that be, folks? The difference is in the results. It's something what we call sequence of returns. And in retirement, that can be absolutely devastating. So if you look at the difference in the order or sequence of returns between the two brothers, you see that Steve's first decade in retirement was a great one in the market. Bill's, on the other hand, was marked by a sequence of big downward turns. And while they both started off with the exact same amount, after 10 years, Bill is left with less than 13% of his brother's account. Each of you here this morning will have different circumstances, but this simple little hypothetical example highlights the importance of two things. First, making sure that you're not overexposed to market risk too late in life. And second, making sure, as we said before, that you have a guaranteed plan for lifetime income so you never are in the position that Bill here, realizing you might have a lot of life left, but not so much account balance, right? Now, I know you might be thinking, yeah, Mike, but if I take my money out of the market, won't I be missing out on gains if the market goes up? And others of you here might be worried that you are kind of behind or you feel like you need to take more risk to catch up. And I truly do get that. We even get asked this all the time. Is there any way to link our money to some of the gains the market is making to basically mirror some of that rise without actually putting all of our money at risk? Now, that's a fair question, right? Well, if there was a way to grow your money if the market continues to go up, but not lose your money if the market goes down. Now, did you know that such a thing does exist? There are actually opportunities like that that are available. But just like anything else, not every opportunity is right for every single person. That is why it's so important that you have a custom tailored plan, not just a portfolio. Take, for example, mutual funds. Many of us here today are most likely invested in mutual funds, which are essentially a collection of different stocks or investments. So let's just make the math super simple, right? Let's say we had $100,000 that we put into a mutual fund. And the next year, the fund we're invested in goes down 40%. Now, how much do we have, right? 60%, $60,000, excuse me. The following year, the fund goes back up 50%. Now, how much money do we have now? If we gain 30%, $30,000 back, right? We now have $90,000 of that 60. Now, people on Wall Street will tell you that the average rate of return for those 2 years is up 5% because they simply averaged the two changes. But does it look like our money went up? We started with the 100, lost 40 and made 30 the next year, and we're at 90,000. So we're really down 10%. So that right there shows you that how sequence of returns can show you that the market might be averaging 5%, but that is not what your portfolio was saying. Another example, we can start with the same $100,000 again. And the next year, our fund goes down 10%. So now we have $90,000. The following year, it goes up 20%. So we gain 18,000 for a total of 108,000. Once again, Wall Street will tell you that the average rate of return is up 5%. And this time you see your money is actually up, actually more than 5%. So that's what we like to call Wall Street math. What's the real difference between those two funds we just illustrated though? It's really just something that we call volatility. So in other words, how big are those swings? And once you are in retirement, volatility is not your friend, okay? So see, in most areas of our financial lives, we get second chances. Say you're in your 40s and invest a little bit in some stock that doesn't perform well. It's not the end of the world, right? You can typically move on from that. But say you have a down year in your early 50s inside of your 401k. It happens, right? But if it's the long game, as we say, hopefully next year will get better. But folks, how many times do most people retire though? Exactly once. And ladies and gentlemen, we do not get a do-over on that, which is why it's all more critical to have a plan, not just a portfolio or a drawer full of investments and products. It's also why it's so important for that plan to be able to adjust over time. So here's the deal. As you get closer to retirement, less and less of your money should be at risk because you don't have as much time to recover if the market should drop. When you had 35 or 40 years to bounce back from losses, it was no big deal. But as you get closer to retirement, your approach definitely needs to change. That's what we call the last 10 years before you plan to retire, the retirement danger zone. If within 10 years of retiring, you're still investing the same way you were when you were younger, you might be at risk of a drop in the stock market that significantly affects all of your retirement options. There's simply far more at stake that close to retirement, and it's just important that each of you here this morning are using different strategies to accomplish that. So April 15th, we all know that date's etched in our mind. But we need to really discuss taxes. So as we finish discussing risk and keeping your assets protected, we're going to transition to the third and final risk that we're going to discuss this morning, which would be the damaging impact of taxes, both now and into the future. Now, I know the dreaded tax word. We all get that same feeling thinking about the T word, right? But taxes are obviously critical and important as we approach retirement because at the end of the day, they can have a huge impact on how much money you actually have to live on once you retire. Now, if you've been listening to many advisors out there, they've been telling you something about what you should do with your money when it comes to taxes. Several of you here have probably heard this advice. So let me see if this sounds familiar, right? You should go tax deferred, right? Now, while everybody else is telling you that, I am telling you that if you have too much of your money tucked in tax deferred, it may very well cost you when you retire. So how could this conventional wisdom from most advisors actually work against you? Let's take a look at it. Let's look at one of the most commonly overlooked areas that we see with clients that come into our office. Why is it so commonly overlooked? Because honestly, most of the time when retirees or soon to be retirees take a minute to explore the topic, their CPA either tells them to always defer taxes when possible, or their CPA has simply read a few articles, given some blanket advice, and fails to take into account the individual situation of the retiree or the very real possibility that taxes might go up. At first glance, it seems like no one would ever make this mistake, right? But I'm telling you, we see people make it all the time. Here's the mistake. In an effort to save taxes on $155,000 of income, people end up costing themselves taxes on well over $1 million of income. So I'm gonna say that again because it's hard to believe, right? You can legally deduct $155,000 of income and not pay one dime of taxes on it. But what that could very well create for you is a situation in which you're later paying taxes on well over $1 million down the line. Let me show you how this happens. Now, at first blush, this page is just covered with numbers, right? But here's the good news. You only need to focus on a few of them. If you look at the chart on the left, you'll see an individual who starts saving for retirement at the age of 35. Let's call him Bob, right? If you look in the third column, you see Bob puts away $5,000 a year into his IRA and continues doing that for 31 years, all the way from age 35 to age 65. So what did Bob do by putting $5,000 into his traditional IRA every year? He got a deduction of $155,000 because he didn't pay taxes on that $155,000 total over the 31 years that it went to his IRA. So a lot of people would say, well, that's great. You know, we saved $155,000 and didn't get taxed. And if you look at the bottom right-hand side of this first chart, you'll see that it says about $528,000, right? So our $155,000 that we got to deduct in our IRA contributions that didn't cost us any money because it was pre-tax. In this example, it ended up growing at a 7% growth rate to a total of $528,000. Now, let's go over to the chart on the right, protection and distribution. What we see happens after Bob retires, right? There we find him at age 66, and you'll see he starts with that same number of roughly $528,000, and that money continues to grow because he hasn't taken any money out. As a matter of fact, he just starts taking money out when he has to. In this example, starting at age 72, because as most of you here this morning know, you have to start taking money out of your retirement plans, whether you need the money or not. That's what our good friend Uncle Sam likes to call required minimum distribution, or RMDs. Under the Secure Act, the age at which you have to take required minimum distribution from your retirement plan has been increased from 70 and a half to age 72, unless you turn 70 and a half in 2019 or earlier. So if you look at that fourth column in the chart on the right, it shows Bob's money starting to come out during his 72nd year. It starts with a little over $27,600 coming out, and then goes to nearly $30,000 and so on. So we're assuming that Bob is still able to earn about 5% interest. Now hop on down and let's look at what happened by the time Bob has turned 85. I think many of us here would agree that with the advances in medical science and increases in longevity, the odds of us making it to 85 are no longer unrealistic. And there we find Bob at age 85, having been forced to take out about $522,000 in RMDs from his retirement account. Now think about that for a minute. The bottom number on the left was that he got $155,000 that he got to deduct from his taxes. It's now left him paying taxes on more than $522,000 in withdrawals, much more than the deduction that he received earlier. But look over at the highlighted box in the lower right. Bob still has $693,000 in his IRA at the age of 85. And all of that is taxable as well. So ultimately, his total taxable amount is $1,061,447. Let me say that again. That's over $1.06 million, y'all. By saving tax on $155,000, doing what we're all told to do, right? Save money pre-tax. And yet, here near the end of his life, he's going to have to end up paying taxes on more than $1 million. Oh, not only that, but if Bob's kids inherit this money, they're going to have to pay taxes on it. And if Bob dies at age 85, how old would we guess his kids probably are? Likely in their 50s, right? Maybe. People possibly in what would be considered their peak earning years, which means they are literally inheriting a tax time bomb. So a couple of things I just want to touch on here, right? This is just an example of what a Roth IRA or possibly a conversion about a Roth IRA might expose. Maybe Bob shouldn't have taken the tax deduction, and then that 1.1 million that's coming out of that IRA would be completely tax-free. That would be called a Roth IRA. But that move may or may not make sense for everybody, right? Each individual situation is different. That's why it's so important that we're able to sit down and visit about these things. Another option might be life insurance. Very wealthy people buy life insurance, but there's a reason they do so. Most people think life insurance is bought to protect you from an untimely death, but there are actually several other reasons life insurance is used. There are reasons very wealthy families have used life insurance for years to pass tax-free money on to their children or grandchildren. You can also use it to equalize an estate in the event you're passing on a business to one child but want to leave an equal inheritance to another, and so on. There are all kinds of uses for life insurance that most people typically don't think about, and that is just another reason to sit down and visit with us, right? One final point on taxes before I move on. Some of you here this morning may be very well served by gifting money before your death into a trust to shift future taxes out of your estate. If you've done a good job saving money and you have people that you love or organizations that you care about, now may be the time to remove some money from your world of taxes and get it to grandchildren or to charity, or ultimately lower your future tax burden. These are all things that we can discuss when we sit down together. So as we wrap up on this third topic, once you receive your response forms, you'll see retirement as concern number 3, paying higher taxes in the future. Check that off as a box that if that's something that you're concerned about, we can make sure we revisit. The reality is that we all have to pay our fair share, but we don't have to pay a dime more than necessary. And the majority of those people walking into our office simply haven't had someone look over their situation to help them make informed decisions here. If you would like for us to address that with you, simply check the address box. And if you think you're in good shape, but would at least want us to explore ways to possibly potentially save more taxes with you, just simply mark the explore box. And if you're confident there are no ways you could possibly save more in taxes, or you're just in that rare individual who simply just doesn't care, just check the ignore box. But go ahead and make sure after you finish the seminar and you receive your responses to answer those questions. Yeah.
What percentage do we have to start withdrawing at 72?
What exact percentage?
Yeah.
So basically, to come up with the exact percentages, this ends up being closer to like 3.4, but it's an accumulation of all of what we call qualified assets for you at 72. So that would be everything from 401ks, IRAs, you have any annuities that are from old pension plans, things of that nature. So all of those numbers are consolidated, and you'd have to take out the initial percentage from there. So the factor ends up, we call it the factor, but it's basically what the table is set up as. They take your dollar amount, they look at your next beneficiary, whether that's your spouse or your next of kin, and they multiply that number out. Like I said, we end up basically seeing about 3.4%. And then as you get older, every year that number increases. So the older that you get, the higher your RMD amounts typically are. So we really would need to be having some more discussions about what are we doing to alleviate what your tax burdens would be.
Thank you.
So just want to show you kind of common questions that we get whenever we do webinars and seminars is when we talk about this lifetime income risk taxes, you know, people always say, Michael, will you sit down with me and take a look at my situation? And the answer is always going to be a resounding yes. Of course, we'd be more than glad to sit down with you and look at your current situation, help you create a plan that makes you feel more confident and empowered for your retirement scenario. So when you do come into our office to visit, you're going to typically receive three things, right? A retirement deliverable, we call it deliverable, but a plan, something that you can put in place, see, touch, feel, and really look at how your income sources are going to be used and tapped, right? Next, we're going to talk about risk analysis on your current investments to ensure that proper percentages of your assets are in the market. And then we're going to do a fee analysis showing exactly what you're paying on mutual funds and different investments. And then our tax analysis will show your current anticipated tax bill versus alternative tax scenarios in which taxes could be reduced, legacy to loved ones could be increased, you know, et cetera. So, you know, when we're talking about taxes, we're going to make sure that you understand that we do have tax planning available to our clients. So we have 2 CPAs on staff at all times, and we'll be more than happy to not only help you prepare your taxes, but do a thorough review of tax planning on how your retirement scenario is going to look moving out the next 10 years. So those are the 3 things that we want to make sure that we're having really important conversations about when you come in for your reviews as well as coming in for your initial visits. So 3 of the most important things that we're going to need to know whenever you do come in, right? So I want to kind of describe to you what it's like to visit with us, right? Of course, you know, you're going to be warmly greeted by someone at front who will always converse with you, find out how you're doing, get to know you, make sure that you're provided with anything that you need, beverage, refreshment wise. And while we're here, when we get here, we want to accomplish 3 things for certain during our first visit. First, I'm going to want to hear your story, right? I just want to get to know you and what is important to you. Second, we're going to want to determine if there's anything we can do to help you. So now for about 90% of people that are attending this today, historically speaking, we can help you. That doesn't mean that we're a perfect fit for everybody, but for about 10% of you, we may find out that you're already in great shape and exactly where you're at. And if so, you know, we'll give you a high five, congratulate you on the work that you've done, and we can send you on your way as friends. But if there are things we think we can do to better your position, and we'll set up a second visit for you and outline those for you as well, what that vision looks like. And then thirdly, we'll just want to get a sense of whether you want our help, right? That sounds good. Now, some of you might be sitting here thinking to yourself, well, Mike, this all sounds great, but I'm not sure what type of net worth client that you work with. You know, is this really for us? And I completely get that, right? Let me make a few things clear though. Whether you are still working, have a few years into retirement, you're so close to a retirement party that you can actually taste the cake, or if you've already sailed into that wonderful next chapter of your life, sitting down for just 1 hour with our team can help you enjoy the next 30 years of your life with increased certainty or confidence. Or whether you don't know what a stock is from a bond, you've got a portfolio of investments, or you could just use a second set of eyes translating things for you. You could be a do-it-yourselfer who grabs the Wall Street Journal finance section and pulls up your stock trades every morning while you're drinking your coffee. Again, sitting down with my team for just over an hour, we can still help you enjoy the next 30 years of your life with increased certainty and confidence. Or whether you've saved a modest amount for retirement, or you've saved quite a bit, but you're wondering if that's going to be enough, or if you have a big enough nest egg put away, or you're just wanting to make sure that you use it in the most efficient way possible. Again, sitting down with us for just over an hour of your time, our team can simply help you enjoy the next 30 years of your life with increased certainty or confidence. So, like I said, we want to know your story. We want to know if we can help, and we want to know if you want our help. So, in summary today, we want to make sure that, one, you have enough income, right? I know we've covered a lot of ground in a short period of time. So, we want to talk about the need to ensure that you have sufficient income in retirement. This is the number one worry that most retirees have, and most soon-to-be retirees have when they come into our office for the first time. We can officially put that to bed for you after we meet with you to start our plan. We also talk about making sure that your retirement assets aren't taking on too much risk, right? When you're in that retirement danger zone, it's no longer time to be taking the risk you might have been taking in your 40s or even your 50s. And far too many people we see coming into our office think they've scaled back their risk exposure, only to find out that they really haven't. We don't really want that to be you, and we want to make sure that we're helping you in that manner. And then finally, we want to talk about ways to help you reduce the effect of taxes in your retirement. We all know that we have to pay our fair share, but there's no reason to pay a dime more than what we have to. And the reality is that if you're looking to a CPA for help here, you're generally looking in the wrong place, because CPAs are historians. They prepare tax returns based upon what's already happened, right? They don't plan for what's ahead. So be sure, no matter who you're working with, that you get some help in this third area as well. And we are going to have time for some Q&A, but I just want to say this in closing, though, folks. I really genuinely believe many of you, your best days are ahead of you. And I encourage you to envision what they might look like. Picture a day when you no longer have to worry about getting a plan together because it's already done. Picture a day when your grandkids run up to you and say, "Grandma, Grandpa, I'm so glad that you could visit." Picture a day when you have the freedom to travel if you want to travel, relax when you want to relax, and give when you want to give. And so together, we can get to that day, okay? So I just want you to know that we were more than glad to have you in to do a complimentary review, assess your situation, and make sure that we have you on track. I think in all of our lives, there are things that we put off, thinking that we can always do them later, but that's not always true. So now would be the time to take that first step. And you all deserve a great retirement, and a great retirement deserves a great plan. You deserve a great retirement that isn't filled with worry, about how are you going to pay for things, or about money in any facet. And you deserve a great retirement that's filled with choices of freedom and joy. So I'd love for you to pick your preferred time to come in and visit with us, and let's get you on your way to what we would consider a great retirement. So with that said, do we have any questions or thoughts that we could answer for anyone? I'm gonna actually Go back.
Don't have any yet.
Okay. All right. So if we answered our first question. Does anyone else have any questions or individual concerns? Pamela Budd.
Well, I think that's from earlier.
Okay.
Here's one. Do you have thoughts about a reverse mortgage?
Yeah. So reverse mortgages are one of those things that I'm not going to say we really like or dislike. They're unique to each person's individual situations. We just had a advisor meeting discussing that. There are some scenarios where using a reverse mortgage might make sense for some clients, especially if they need income, but that situation is pretty unique. And so we'd have to almost see what that situation is before we could tell you that we think it makes sense. There are a lot of options out there with reverse mortgages. So if someone was in a position where they needed it and needed that income for the equity out of their house and they had no other sources, then we could probably look at doing it, but making sure that it's the right product for them. You know, I've seen some reverse mortgage options where clients would lose, 50 to 60% of the equity just to take income for a couple of years, and that didn't make sense. So, but yeah, we could definitely discuss it and talk about it, but we would kind of need to see the whole scenario before we recommended any direction. And hopefully that answered your question. Anyone else has any other questions or thoughts about retirement or income planning or anything of that nature regarding finance? We'd be more than glad to assist you or answer them for you.
Yeah.
Okay. We'll wait for a few more minutes just in case someone else has a question. Okay, so how about taking retirement at 62 versus delaying? So we would need to look at what that income planning looks like for you. So if you retired at 62 and you will be able to generate enough income and taking your Social Security early would still put you in a good place, and that's what you wanted to do comfortably, then it's something that we could do. We don't typically recommend retiring at 62 for Social Security benefit standards, but there are always going to be, unique scenarios where it might make sense, or the difference in what you would get at full Social Security versus what you're getting at 62 would not affect your life in a way where you can still enjoy it. So it might make more sense, but to answer your question, Frank, we would definitely need to look at your individual situation to see whether or not it makes sense. Okay, we had a question about whether or not we can expect Social Security to continue for life, or is it possible that the funds would run out? So the way the Social Security is actually structured, the funds should not actually run out, right? We pay into Social Security every year. Every one of us who are working in any facet pay into Social Security theoretically to help cover the people that are actually being compensated for the plan. The issue that you hear about with Social Security not having more than 13 years of solvency left really comes because the government actually borrows the money from Social Security and then uses it for other uses. The issue that we will probably have is that we will either have to reduce benefits, delay the starting age for Generation X millennials, or raise taxes in some facet to cover the deficits that we're having in our government. To be honest with you, they'll probably raise taxes first. Whoever does so won't be reelected, but it's a necessary evil that will probably happen. So I do expect Social Security to last, whether or not it becomes privatized or the reductions start happening. It should not happen in anyone who's retiring soon, right? If you're in retirement right now or you're planning retirement, you should probably still have a stable Social Security. But for those of us who might be in our 30s or 40s, there might be a delay. So it might not be 62. It might be the first eligible date is 67. So that's probably what will happen. But, I wouldn't call it a volatile situation, but it's definitely one that is discussed in the halls of Congress often. And we will see what happens throughout these election cycles on who's going to be the person or the party that steps up to change it. Yeah. All right. Well, great questions too. Anyone else has any questions or concerns or thoughts that we can help you with? Hopefully I answered those questions clearly. If I didn't, then, I can go back and expound on them too. Okay, perfect. Okay. All right. Before we head out, does anyone else have any other questions? Again, we will be sending you all out packets for review and feedback, as well as to schedule an opportunity for you to come in and sit with the team. So again, we really and truly thank you for attending and appreciate everything that you do for us. And hopefully, you all can come in if you're not a client and sit down and get a review and let's get your income plan, a plan on paper, and make sure that your retirement is comfortable. And we've done what we can to help you. So, all right, I think that's it. Okay. Well, you all have a great morning, and we look forward to seeing you soon.